I've mentioned about gold, 2400. I've mentioned about euro dollar, 185. Okay. I've mentioned about Aussie dollar here, 0.67. GBP USD. Talked about US dollar index as well, down here, 104. Okay. Euro Aussie. Did I mention something about Euro Aussie? I did mention, right? I did mention short. Can you share the crystal ball? Unfortunately, no. CHF JPY. Aussie JPY. What else did I had? I had something else. I had something else that I've mentioned about it. USD CAD. No. Oh yeah, it was USD CAD here. But there was something else as well. Something else as well. What about the copper? Oh man, don't trade copper. So, oh, already 5 minutes. Okay, let's go. So guys, crazy stuff's happening. Crazy stuff's happening. I'm so happy. I'm so happy. You can't imagine how happy I am to see everyone that was against me telling that I was wrong, telling this, telling that. Well. Um, um, and then, um, and then to see that everyone, just was laughing and now they're crying. Anyways, so guys, let's have a look on the CPI, and it was so good, right? Because on the YouTube, it's on the YouTube. I've mentioned it was gonna be on the Telegram. Okay, it's on the Telegram as well. I've mentioned that. Where is this? Here. The risk reverse on euro dollar continues to strongly point upwards. Okay. What else here? OER carries a weight of 33% in the core CPI, so a decline of this magnitude from 0.48 to 0.29 will reduce the core inflation by 0.06 month over month, meaning that this variable alone would push the core estimate from 0.3 to 0.2. Okay, let's have a look. Yesterday, 0.3. 0.3. Done, right there. Okay, so now I've done a blog post today. Let's see if it's up already. So we're gonna go through that. Otherwise, I can just open the file. Market analysis here. Okay, it's loading. There we go. The trade idea generation behind the long euro dollar on USA CPI. I start saying the market is chaotic right now. We've seen PPI and the CPI behaving completely erratically. On one side, PPI came in much higher and the US dollar index dropped as if we were no tomorrow. Then yesterday, the CPI came in lower and the market continued to drop. Something wrong, isn't it? Well, it's not, okay? This is called a market change. I see someone, let me see who was it. Oh, Sweets was talking about, got a little bit confused about the PPI came in higher and the market reacting higher. We're gonna get there in a second. And this is exactly what I say. It's a market change, okay? And one thing we need to understand is that the impact of economic news on currencies isn't straightforward. Okay, it's all about the context. What make one currency stronger one day, it might drag it down in the next. So smarter trades, they don't just chase after the latest news. They keep an eye on the broader picture. And this is exactly why I've elaborated my trading strategy that I've gave it to you guys already for free. Okay. I've mentioned how to use, I've mentioned what to look, CPI, central bank, monetary policy committees. I've mentioned everything. You guys have everything right on your hands. Okay. It's just a need of taking action. I think Julian knows more how I trade because I think he sort of have the same concept, but I'm not here to say who doesn't, who do anyways. But the tools as well helps you, all right? It's okay. So some people may say, oh, the Bloomberg doesn't help. It does. Okay, it's a tool that does help. It makes easier for you to collect data. Okay, it makes easy for you to go and see what you need and see what is happening, what are the predictions and so on. So it does help. Second thing is people believe only in price action. This is completely wrong. Price action don't move the market. What moves the market is economic data. Okay. And third, people believe only on that data. They try to trade the data. You need to understand that trading a data, it's highly risky. It's highly risky and very, very low in effectiveness. So let's say you want to trade the CPI. 30 seconds before you're going to long it or short it. Sometimes you can get it right, sometimes you can get it wrong. But you need to understand all the costs behind this. The spread we want, man. Try to understand the overall context. This is much better than trying to get only one right and satisfy your happiness for that second. Oh yeah, I got it right. You know, get a stimulus to your brain, and it's just not valuable. All right, it's not worth it. Anyways, so I just quoted here, all right, from a book, 48 Laws of Trading. It's one of my friends, the trading meme page on Instagram. By staying informed, looking at how things have played out in the past, and being ready for different possibilities, traders can navigate the tricky waters of the market more effectively. Remember, it's not just about reacting to the news, exactly what I've just said. It's about understanding the whole picture, understanding the whole story. So you need to understand, okay, CPI came higher. Why did it came higher? Because most probably the people are spending. Okay, let's have a look where the CPI came higher. Okay, so then we go CPI, CPI products. And then we go here. Well, let's just go for the Bureau labor statistics CPI latest numbers here. Okay, there we go. Let's go for city average, all items, less food and energy, medical care. Let's have a look on all items. Okay, so the data is here. Wow, voila. So the data is here, okay? So we can see that the CPI have decreased it from 0.6 to 0.4, okay? And we can see that there is the chart here. Usually this is the bottom and this is the top. Now, if you want to see less the food and the energy, you can come and have a look here. Okay, that was a big decline from 0.5 to 0.3. It's good. And you can have a look on all these stuffs as well. There is a table that I want to show you guys, is the CPI inflation products USA CPI. I think it's this one. And then we go to maybe here. Let me see. No. Oh, actually, show table. That's not what I want. Just a second. HTML. There we go. This is what I want. So basically you can see everything here. Seasonally adjusted changes from preceding months. Okay. So we have all the items. So all the items combined. Okay. This is what we're gonna have. 3.4% in total. Okay. We have only food. We have only food at home. We have the food section, sorry. We have food section and we have food at home, food away from home. So food at home means bread, milk, those types of stuff that you buy for your house. And then the food away of home means like dinners, restaurants, and so on. Energy commodities, gasoline, all types, mean petrol, E10, 98, 95, 91, all the gasolines. Full, sorry. Full oil, energy services, electricity, utility, pipette, gas service, all items less food and energy. So that's the core. Commodities, less food and energy. New vehicles, used car and trucks, apparel, medical care commodities, services, less energy, shelter, transportation services, and medical care services. So you have everything here. Let's have a look on those numbers, okay? So what did actually came in higher and what did actually came lower? So from March 2024 to April 2024, the food items, sorry, all the items had a decrease of 0.1%. Okay. Food had a decrease of 0.1 to 0. So it didn't even had inflation on food. Food at home actually had low inflation, so negative 0.2. Food away from home stayed the same. Energy stayed the same. So same. Gasoline went up because of oil prices. If we remember, we saw the oil prices went up. Okay, so reaching nearly $90, it was 87 or 88. So that was an increase of inflation from 1.5 to 2.7, so nearly 1.2% here. Then we had gasoline, all the types, of course, it went up. Full oil went up as well from negative 1.2 to 0.7, 0.9. And then energy services went down, okay? And then electricity went down, that's pretty good. Utility piped gas service went down as well. And then all items, less food and energy went down, okay, 0.1% lower. Commodities, less food and energy commodities went down, 0.1. New vehicles went down, okay. Used vehicles stayed this, well, went down as well. Used car and trucks went up. Sorry, this one is used car and trucks, apparel, this one. Next one, medical care commodities went up. Medical care services, less energy prices. Sorry. Yeah, services, less energy prices. It went down. Shelter stayed the same. Transportation services went down. And medical care services went down. So we had 1, 2. This is the same. 3. That's up. This is up. This is down. This is down. This is up. This is down. This is down. This is down as well. This is down as well. This is up. This is up. This is up. This one is same. This one is same. This one went down. This one went down, and this one went down. So from 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, well, actually 20 items. 2, 3, 4, 5, sorry, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So 12 went down and 8, but well, not 8. 1, 2, 2, 3. So 5 went up and 3 stayed the same. Okay, so from 20 items on the basket, 12 of those items went down. So the majority of the basket went down. 5 of those items went up, and 3 of those items stay the same. It's not actually an item; it's actually a section of a market, but it continues just the same thing, just so it makes it simple. So very interesting. Majority of the basket went down. So I'm very interested to see already what's going to happen next month. Okay. Because if we look into inflation actually cooling off, then the whole thing that I was talking on the Telegram may be very close to happen. Okay. Very, very close to happen, because if we think about it, that the Fed is actually working in collaboration with Biden, let's say, or Biden working in collaboration with the Fed, they can, if they want, they can. That's not a problem. But that would be very interesting to see, because most probably that those numbers are tweaked. Okay. I was talking with one of my friends and he was like, yeah, the food inflation is actually a lie, because I'm not saying this. This is what he was saying. You know, food inflation may be a lie because they can just take the cheaper food to look. Okay, let's have a look at the meat prices. They can just take the cheaper meat. You know, so that's gonna be very interesting to see from now on. Okay, let me delete all of this. Now, we did have the CPI month-over-month coming lower, as expected, but what actually moved the market quite a lot was the retail sales. They removed coca. Yeah, that's true. So the retail sales month-over-month came in at 0. Okay, so pretty much no sales from the month of April. And I've mentioned that quite a few times already, that more people spending generates more inflation. So if we saw no spending through the economy, that sounds a little bit sketchy. Because if we take the credit card spending or the M2 spending, that won't be on break even. All right, it won't be. It will probably be a little bit up. So that means that's something happening. Okay, there's something happening. I don't want to be the guy that you know, okay, the market will collapse. No, I'm not that type of person. But look, mate, there's some big things happening. I can guarantee to you that. So when the retail sales came and revised it down as well, like, oof, that's a problem. Then we had the GDP for Europe as well. The GDP for Europe was 0.4%, and the GDP, year over year and the quarter over quarter was 0.3%. So in line of expectations, nothing has been revised down or up from the previous. So it's still pretty normal, pretty chill. Okay. Okay. So if you are not on my Telegram group, here's the link. Okay. So I was wrong on the slowdown in the rent inflation. I was wrong, because if we see here, the shelter prices, they came in as the same 3 months already. So February, March, and April. All right, just in January, we had a huge uptick, but tends to see, all right, if we look from October to April, the normal distribution here will be around 0.45. So if we take a calculator, okay, why my calculator is so huge? If we take a calculator, 0.3 plus 0.4 plus 0.4 plus 0.4 plus 0.6 plus, oh, actually it's already here. 5.5 divided by 1, 2, 3, 4, 5, 6, 7 divided by 7. Oopsie, sorry. Damn it. 5.5 divided by 7 give us 0.78%. So that's closer to the 0. No, but there's something wrong with it. It can't be 5%. That's impossible. 0.3 plus 0.4 plus 0.4 plus 0.6 plus 0.4 plus 0.4 plus 0.4 divided by 7. There you go, 0.41. Okay, that makes more sense. So I'm not saying, but looks interesting, because if we get this set of data here, we can see that it has been rovering around of the number of 0.4 for already 4 months. Yeah, 5 months of out of 7. So that's pretty interesting. Okay, we only had 2 different ones, one higher and one lower. The higher one 0.6 and the low one 0.3. Again, I was wrong. And look, I put my, I put my hat here, and I was like, okay, cool. Sorry, I was wrong. This is it. I've been wrong. I've been wrong. You guys know, you've been following me for a year already. I've been wrong. And I tell, okay, I was wrong. But one thing that I'd say is we need to understand why we're wrong, and we need to look out and see how can we do better. Okay. But anyways, so the slowdown in rent inflation, I was actually looking at an analyst from the Standard Chartered chief currency strategist, Stephen Anglin. He was the guy that pushed up this thing here, right? But he was wrong as well. So do I. Second, the political impact on rate cut expectations. One thing here is that the market now is pricing 2 cuts. Okay, the market now is pricing 2 cuts, and I was right. So if we look here, with the approaching US presidential elections and geopolitical statements indicating a possible rate cut by the Federal Reserve before the year's end, there's an expectation that inflation will need to decrease to justify such cuts. And this may influence how data is presented or perceived, leading to a potential negative surprise in the report. We can notice by these we can notice these by observing Powell's confidence in delivering a Davos speech last FOMC meeting on 1st of May. We also have Yellen at the Bank of Japan intervention. What a timing. It's just works so perfect, doesn't it? So anyway, so let's have a look here. I have a position here on Eurodollar, so I'm just watching out. Sorry for that. Hedging my longs out. True shorts. Okay, so 31st of June, 12th of June, 91% of the market is expecting no changes. 31st of July, 60% of the market is expecting no changes. 18th of September, 51% of the market is expecting 1 cut for 25 base points. Okay. 7th of November, no one is expecting anything else. Remember that I've mentioned last time that there were a possibility of the market expecting a cut on November, but then from September to November, I wasn't too sure. I was like, nah, this can't happen. Okay, so most probably they would jump to December, and that's exactly what they did. So 38% of the market is expecting 25 base points cut from the Fed, and 26% of the market is expecting no changes. So there are 2 cuts, sort of one very priced in, that's on the 18th of September, and the other one is not priced in. Okay, I want to go and say this. I may be wrong, but I may be very wrong. I think this is BS. I don't think the Fed will cut the rates. I don't think so. I think they are manipulating the market to buy a cheaper treasury, cheaper MBS, mortgage-backed securities, and cheaper US dollar. So then they can buy from so they can sell their things. So they can buy from other countries on cheaper prices, and therefore work with that as a good thing because inflation is coming down. So remember what I just said. They are influencing how data is presented or perceived. Okay, so here we have that this is from Goldman Sachs research, and they say we expect CPI shouted inflation to run at a similar pace to last month's. They were right. So that's very nice. Very, very nice. Okay. Our rent growth decelerated by the OER rent gap normalizes most month decline. Okay, those two other things here are very important. That's the third one is the lag data and random fluctuations. So the experimental data used to estimate the OER are based on a small sample of rented single-family homes and are collected quarterly. These can lead to random fluctuations in monthly data, resulting in estimates that may not fully capture current trends in the rental market. So I've made very clear. And the fourth one is the disconnection between real-time metrics and the CPI data. There's a significant lag between real-time metrics in the rental market and their representation in the CPI. Currently, even if rents are starting to rise in various parts of the country, this will not be reflected in CPI data until 2025, which may result in lower than expected numbers for the upcoming months. But then in 2025, there is a possibility of us feeling that inflation that was made in 2024. Okay, so that's what I'm saying. The Fed 100% they know these, so they will have to maintain these rates higher for longer to survive to 2025. So why would they cut when they know that the inflation is a lagged indicator, the CPI is a lagged indicator, and that will actually be felt into the economy in 1 year? So why would they cut if they've done so much work already to bring inflation to 3.2, something like that? I can't remember now. 3.2, yeah, 3.2 or 0.3 month. Why would they cut the rates if it's working? We don't move a player that it's working, all right? It's from soccer. We don't move a player that it's making scores. Anyway, so going ahead here, on Monday, the Federal Reserve Vice Chair Jefferson adopted a hawkish stance, emphasizing the need to keep rates in restrictive territory until there is a clear evidence of consistent inflation reduction. He emphasized the importance of clear and cautious communication to avoid misunderstanding and generate market certainty. Okay, one thing I want to see now is USA, oopsie, month over month inflation. Is inflation really going down? Is it? I don't think so. Okay, so we had the inflation came in at 0.3, and we had the year over year 3.4. Inflation is too high at 3.4. That's kind of high. But look at that. Inflation went up. And that was the first release of ever of since October 2023. That was the release lower. Okay. But inflation continues to go up, guys. So what does that mean? There is still strength for the US dollar now. When the market perceives these, when the market see this move here, if inflation was going like that, then yes, would be short US dollar all the way. But we need to understand. That's exactly what I've said. We need to understand how the market changes work. And it's right here. This is called a market change. One thing we need to understand is that the impact of economic news on currencies isn't straightforward. Of course, the news came lower, the inflation came lower, therefore the market will jump. Of course they will. But it's all about the context. Why did the market go, the US dollar so down and euro dollar so up? I knew this would happen. I knew, because the market was already trying to see if the inflation come lower. That was the first after 6 months. 6 months. After 6 months, one reading came lower than expected. Of course, it will have a huge impact. Of course. Okay. So 1, 2, 3, 4, 5, 6, and then lower. Simple. It's simple. Okay. What makes a currency stronger one day? Listen to this. One day might drag it down the next. Smart traders don't just chase after the latest news. They keep an eye on the broader picture. By staying informed, looking at how have played out in the past. Look, this is easy. Okay, here we see August, September, October. Let's take September to October here. Oh, well, let's take August to September 2023. Let's have a look on euro dollar prices. This was, when was that? August. January, oh, that's 2024. Okay, 2023. Okay, August here. So we had August sort of coming low until October. Okay, until October, inflation was coming low. But then if we look to 5 years, I wanted this. Where is this? 2023, May, June, July, August, October. See here, when they showed that inflation was actually came in higher, all right, only one reading lower, well, the market dropped. But then October started, and then November, inflation continues to go higher. Look at what's happening. The market went up. Okay, so voila. Welcome to economics. Okay, this is it. Pretty simple, isn't it? Now, let's go ahead here. So on Monday, as I was saying, Federal Reserve Vice Chair Jefferson adopted a hawkish stance, that saying to the market that, guys, you need to look to the broader picture. We still have high inflation. We still have job to do. The continued emphasis on observing and responding to inflation reflects a firm policy against persistent inflationary pressures, reiterating the Fed's commitment to stabilize prices and sustain economic progress. Now, having all of this in hand, we can understand why the CPI came in lower, because the rental prices as well as energy prices are dropping in the USA. I'm telling about rental prices. I'm not telling about the shelter prices, okay? A bit of a difference here. The rental prices went down. That doesn't mean that the shelter price went down. But just a reminder is that this data is easily able to be manipulated. I'm not saying it was. There is a high probability that it has been, as elections are looming and Biden needs to maintain his good reputation. Therefore, working with the central bank is a good option. But another reminder is that the Fed claims to be an independent institution, meaning that they don't take anyone's opinion or demands or rely on a third-party opinions to act on the monetary policy of the USA. Having all of this in hand, the only position that makes sense for me is the Euro USD long. As well, the Euro still has some strength despite inflationary coming in lower in Europe. But compared to the USA, the GDP there is much better. You can access this link to have a look at my previous post where I talk about the GDP comparison of Europe and the USA. So let's click here. You can see right here that USA is below the Europe, isn't it? So that's pretty cool. So I actually say here, one factor behind the dollar's loss of momentum is the evident economic growth outside of the United States since the year began. Europe has experienced a notable income economic recovery, with the Eurozone expanding by 0.3% quarter over quarter in quarter one, its fastest quarterly growth since quarter two 2022. Similarly, the UK economy surpassed expectations by exiting a technical recession in quarter one, expanding by 0.6% quarter over quarter. Projections suggest this growth trend may continue into the middle of the year, with some moderating expected in the UK in quarter two. China's economy has also shown signs of improvement in spending by 1.6% quarter over quarter in quarter one. Conversely, recent indicators hint at potential slowdown in the US economy. Growth have eased to an annualized rate of 1.6% in quarter one, following robust but unsustainable growth for 4.1% in the second half of last year. Moreover, recent economic data for the beginning of quarter two has been disappointing, with the Citi US Economic Surprise Index dipping into negative territory. So there you have it, like United States is below US, below Europe. Okay, so US is below Europe Union, the 27 countries from 2020. So very interesting to see this, right? And then I finish here. This content may have been written by a third party. This is not me that writes, but anyways. Now, other move that made lots of sense to me was the gold. I'm very close to my target of 2,500. Okay, I'm looking at 2,500 for quite a bit already. It's not a bad point too long again, but let's see. Putting the 1 hour here. One thing that makes me afraid is that it didn't came up to take this consolidation here. It makes me think twice. Same as euro dollar. I'm expecting euro dollar to do a little retracement towards this area or this area. Like Fibonacci won't help anything here, but yeah. If we do a Fibonacci expansion, just got hit there. So yeah, let's see how it goes. Let's see how it goes. Anyways, do you guys have any questions? Is it? Oh, wow. Yeah, wow. Next target probably be here. 7,300. First target here. Yeah, looks good for me. Looks good for me. Yeah, I'm not sure about Bitcoin, mate. I'm not a Bitcoin person, but anyways, so no one have questions. Okay, so then let's move on. So today we're not going to have anything. That was very clear. Was it good? Still have questions on the CPI, or can we move on? Oh, good. All right, cool. Okay, so today's economic calendar, we don't have much. We have the initial jobless claims as a weekly data, may have some impact, may not have. Let's have a look on that. Philadelphia Fed Manufacturing Index, that may be a little bit of impact. And that would be it. Economic forecast, this would be important to have a read on that. But tomorrow is a good day because we're going to have the CPI from Europe. Look, I still have to collect the data from. I still have to collect some data to see what I'm expecting, but most probably we will have a lower reading. Okay. It could be as expected, because that will be already lower. But if it comes even lower than the expected, that would be good for shorting euro dollar. Okay. So at the moment, euro dollar is still observing those long positions, so you still have a lot to do with that. But please, what's your long-term target on euro dollar again? 1.10. 1.10 is my long-term target on euro dollar. So does MUFG as well. Okay. So the core CPI and the CPI, let's have a look on that. Understand the bigger picture. One thing that I want to already make sure you guys understand is that last year, the ECB came in and say, look, we will be a little bit sticky on the inflation. Okay, we will be a little bit sticky on the inflation. Therefore, we will be rovering around the 2.4. All right. So let's have a look on that. Statistics. There we go. So the euro area is at 2.4%. The lowest is Lithuania in 0.4, and the highest is Croatia to 4.9%. The HICP, the Harmonized Index of Consumer Price, is decreased to 2.4% from 2.6. Yeah, this is a big decline from 2.4 to 2.9 to 2.9 to 2.9, 2.6, and then 2.4. I think they will rover around the 2.4. Okay, I'm most surely that they did that. Let me see. Where is this now? Monetary policy. The monetary policy. Oh, monetary policy. Decision statements and accounts. Monetary policy decisions. There we go. This one, 11th of April. Monetary policy statement. Okay, economic inflation. Inflation has continued to decline from an annual rate of 2.6% in February to 2.4% in March, according to Eurostat's flash estimate. Food price inflation dropped to 2.7% in March from 3.9% in February, while energy price inflation is stood at negative 1.8% in March after negative 3.7% in the previous month. Goods price inflation fell again in March to 1.1% from 1.6% in February. However, services price inflation remained high in March at 4%. Most measures of underlying inflation fell further in February, confirming the picture of gradually diminishing price pressures. While domestic inflation remains high, wages and units profit new less strongly than anticipated in the last quarter of 2023. But unit labor costs remain high, in part reflecting weak productivity growth. More recent indicators point to further moderation in the wage growth. Now it comes. Inflation is expected to fluctuate around current levels in the coming months and to then decline to our target next year, owing to weaker growth in labor costs, the unfolding effects of a restrictive monetary policy, and the fading impact of the energy crisis and the pandemic. Measures of long-term inflation expectations remain broadly stable, with most standing around 2%. Okay, so they are most looking to inflation to reduce further. So do I. Okay, but yeah, between those levels of 2.4. And if you look here, that's exactly what the market's expecting. No changes. Okay, they're expecting a month-over-month change to lower, but let's see how this is going to be. Look, I don't have any trade idea at the moment. I don't want to just give you guys, okay, this is what I'm looking. No, because I don't. All of my targets got hit. So during the weekend, I will be working on what can I possibly bring for you guys next week. But today was just to explain what was everything happening on these crazy moves. So if you guys have any questions, please ask me. Otherwise, we can finish for today. The PPI. Oh yeah, true. PPI. How about yen? Look, mate, I'm not willing to touch Japanese yen at this moment, just because the US dollar is crazy, Japanese yen is crazy. When you put two people crazy in the same room, something good won't happen, man. PPI. So the PPI is the price, the producer price index. How did you analyze indices? What do you mean? Nasdaq. Oh, I don't analyze Nasdaq. You saw on my on here, right? Nah, that's the S&P 500 actually. No, I don't do. I just leave it there so I can check. See it. So PPI came in month over month, came in higher at 0.5%. Okay. It came out well and affected my bias. So okay, why did this affected your bias? On which way? That's what I'm saying. You guys are not looking to the broader picture. You need to. I'm gonna be picky, bro. You guys need to understand the bigger picture. The bigger picture is Europe is decreasing inflation. We just saw that. But US is still increasing in inflation. So this lower US dollar move won't be repercuted for the whole year. Euro dollar won't go another leg higher. I'm not saying this could happen. I'm not saying that one, but you know, just so you know, just so you get what I'm trying to say is euro dollar won't have another. How many points was that? Let me check. Since the PPI, 128 pips. All right. So it won't happen like this again. The reaction was much. Okay, so guys, again, what's the PPI? It's the producer price index. All right. And the CPI is what? It's the consumer price index. One measures the inflation for the consumers, and the other measures the inflations for the producers. Therefore, having those things combined, the producers will never take the cost for the inflation for themselves. They will put into the consumers. Therefore, when the consumers spend, they will buy something with the price of inflation on top of it. Makes sense? So then the producer don't have to pay the price for themselves. Now, the PPI came in higher, but the buyers of the market was ready. Okay, we already know that this will come higher, but we know that the consumer won't spend it. So if the consumer is not spending, they're not buying, therefore they're not getting the inflation into their pockets. Does that make sense? But look, that was a big miss. Okay, 0.3 and negative 0.1 here. Revise it down, of course. That's what I'm saying. They put the numbers up if they want to do something, and then after that they just revise down. Okay, so it's very tricky of them. So which is more volatile? The CPI. CPI is more volatile at this moment, okay? If we go for another market scenario, then the PPI will be more volatile, or maybe NFP will be more. Remember last year, sometimes PPI didn't even have an effect. Price consumer expenditure, yes, correct. Sorry, what do you want to know about the PC? So it just depends the picture, okay? At this moment, it's more important the CPI. Why? Because the market is looking for the central banks to maintain the rates or reduce the rates. So they want to know what the rates will be done. So therefore, what measures this is the CPI. If the inflation is coming lower, we will cut. If not, then we won't. What did you expect about PCE? Ooh, I wasn't expecting anything about the PCE, price consumer expenditure. I wasn't expecting anything. Yeah. No, I don't have data on that, mate. Sorry. Okay, guys. So this is all from me today. All right. I don't have any trade ideas, unfortunately, because all my trade ideas have been target hit already. But we will come with some new targets, new trades next week for sure. So be ready. I hope everyone is safe during this volatile market. Use risk management. Know what you're doing. Yeah, CAD CPI, it probably won't have the same effect. Market is looking to all these stuffs at the moment, like US CPI, Europe CPI, and so on. All right, guys. I hope everyone have a good weekend. Relax, and we come back next Tuesday. You're more than welcome, Julian. Thank you so much. Thank you, Sweets. Thank you, Iran. Thank you, Zodwa. Thank you, Anwanu. Thanks, everyone. Have all a good weekend, and I talk to you guys next week. See you all. Bye bye.